just talking about where we have been and in terms of our chapters we've already covered. We talked about the fact that we have spent a lot of time on assets in chapter 10 and 11, looking that we record them at fair value. We had to think about impairments. We talked about gains and losses when assets are disposed of. So those are all ideas that are going to carry forward into chapter 12 because we're talking about assets again, but we're going to add some new reporting issues to the story. We also have already covered chapter 14, which is our chapter on long-term debt. In chapter 14, we learned about initially recording debt at the present value using the market rate. We had to consider amortization with that effective interest method. We looked at the amortized cost and the fair value option as part of subsequent measurement.
Go to the faculty. I'm sorry.
Alrighty. So, in this chapter, in chapter 12, we're again talking about assets, so debt securities. We're going to look at buying bonds this time instead of issuing bonds. So instead of interest expense, we're going to be looking at interest revenue. And then we'll have some issues regarding reporting that we will also be considering. And then lastly, we had just finished chapter 18, which covered equity. In the equity chapter, we talked about common and preferred shareholders. We talked about paying dividends. And in this chapter, we're talking about buying stock. So again, it's the same idea, gives us the same rights, except now we're going to receive our dividends rather than paying them. Plus, we have some new issues regarding the reporting, okay, all the way through. So there's a lot of ground we've already covered that gets repeated in chapter 12. So that helps in thinking about it, not in terms of being so daunting. Where we're headed in chapter 12, I talked about the idea that there are just some very overarching ideas with investments to keep in mind, why people would make investments. We talked about this in class, for cash flow reasons or capital gains or strategic synergies. So we spent the first good part of this first day in chapter 12 looking at the footnote from Coca-Cola, and we spent some time filling this footnote in. So we looked at, the three categories that are covered in the chapter. Those were held to maturity and available for sale and trading. For the, make that a little bit bigger, for the debt investments. And then for the equity securities, we talked about this idea of a passive investment or lacking significant influence, I think is what your chapter says. And that's where you own less than 20%. And we talked about this whole new accounting method, the equity method. That's when I call that an active, or your book calls to significant influence. And by significant influence, that means this is an investment where you own between 20 and 50% of the outstanding stock. All right, so that's where our basic categories. We spent some time then at the beginning of the chapter talking about where the unrealized gains and losses are reported, and I'm just going to fill this in. We talked about available for sale. Those are the ones where the unrealized gains and losses are going to go through OCI. Other comprehensive income. Trading securities, those unrealized gains and losses are going to go through net income. We talked about the fact that unrealized gains and losses arise as you're holding an investment. Those are things that happen because you own the investment and continue to hold it. Equity securities, we said any of those unrealized gains and losses, changes in values, are going to go through net income. And with the equity method and the held to maturity categories, we said we don't really recognize unrealized gains and losses except for this little asterisk situation, and the asterisk was that if you chose the fair value option, would result in unrealized gains and losses. And if we had such things, they would go through net income. All right. Now, unrealized gains and losses are the things that happen when you are holding the asset. When you actually sell the asset is when you have realized gains and losses. We talked about that a little bit. And then it's just like any other asset. When I sell an asset and I recognize a gain or a loss, that's going to go through my income statement. And then the last little section on this handout was how are those different securities valued on the balance sheet. And we talked about this with our held to maturity. Those are the ones management intends to keep primarily for cash flows. Those are going to get carried at amortized cost, again, except for that fair value option. Then they'd be recorded at fair value. The available for sale are going to be carried at fair value, as are the trading and the passive equity securities. And then the equity method, those active equity investments, they're going to follow the equity method reporting. Okay, except if we have had a fair value option, then they would be at fair value. So we spent a good bit of time doing this together, that first beginning of chapter 12. So there's that. We also spent a good bit of time either that same night or the second night, I guess, the second time we talked about chapter 12. We spent a few minutes looking at this handout, which covered the things that happen once you own an investment. What are the activities, the subsequent activities that you have to keep track of? And with the debt securities first, and I'm just going to keep the same categories that I had on the other side. I think I had them in this order. Available for sale and trading. Whoops. Just real quick. Remember we talked about those categories, classifications are based on management's intent. So it's how management plans to use that investment. Held to maturity is the one where they're going to keep it until it matures, hence the name. Trading, they're going to actively look to make gains by trading it when the price is right. And then available for sale is I call it kind of that wishy-washy middle. Not going to commit to actually holding it or trading it. So it's classified as available for sale. But the subsequent activities that we had to keep track of, for each of these, remember we're talking about the same economic instrument, okay, the same financial instrument. It's a bond. We talk about a bond that is the identical bond in all three cases. And so if we have purchased a bond and we are holding it, we are going to have to recognize interest income. So that's going to be the same across each category. And I know we talked in class about the fact my pen isn't working. We talked in class about the fact that you can use the words revenue or income here interchangeably. All right, so there's one thing. We're going to have to recognize interest income. We're also going to have to recognize and deal with any premium or discount amortization, regardless of the classification. Also have that plus premium, discount, amortization, here we go. Sorry, that just completely stopped working. Now it's thinking about working again. All right. So big idea. Each bond, you have to do interest income and premium discount amortization. That's going to happen because we're talking about the identical financial instruments, just that management has made a choice as to whether the classification is held to maturity, available for sale or trading. What then gets added in, wow, this writing is really bad. This says amortization. That's what it's supposed to say. With the available for sale, with the available for sale securities, as we also are going to have fair value adjustments plus fair value adjustments. Okay, so we would have that going on as well. So those are the subsequent activities. This handout also asks us just to think about subsequent measurement, just a reminder. Okay, so if you think held to maturity, this is actually on the front page too. This gets recorded and reported, I should say, at amortized cost. We talked about the fact that available for sale gets reported at fair value, and the changes in value go through OCI. And trading securities get reported at fair value, and those changes in value go through net income. Okay, so you should have that filled out for yourself anyway. All right, and then we talked about the equity securities. We're doing the same thing for those. Think about what happens after the fact, and just a reminder, the passive ones are when you own less. Why is this doing this to me? When you own less than 20%, and the equity method is when you own between 20 and 50%. All right. So here, if you were, look at your handout, it's the same thing. Subsequent activities. I just don't have enough room to put all that. So we talked about the fact that both of these equity investments, you're going to get dividends. And under the passive equity investment, those dividends are going to be recorded as dividend revenue. And you're also going to have a fair value adjustment. And we talked about under the equity method, the dividends received are a return of capital. And we talked about the fact that you also are going to record the percentage share. It's going to go into my next box of net income or losses. Okay, so with the equity method, we're going to have to keep track of dividends as return of capital, and we're going to keep track of our percentage share of the net income and losses. So we remember this is reporting at the equity method, balance, and this is reported at fair value with the changes going through net income. Right, so that kind of finishes off that. That doesn't it does finish off that handout. So we spent a good bit of time on that in class. And then we were ready to do some activities. Of course, there was a quiz that we had to do, which basically is asking about the activities, blah, blah, blah. What's an unrealized gain? All right. We're almost ready to do activities. The other thing we talked about in class was this idea of the fair value hierarchy. And I told you if you went back to your book, you'd have to go all the way back to chapter 1 to find this. But We use the term fair value a lot. We haven't really talked about where do the fair values come from, and this is the answer to that burning question. Where do the fair values come from? Basically, GAAP has a hierarchy of fair values. You have to use level 1 if it's available, and level 1 is a quoted market price for the identical asset. We talked about how that's the most verifiable, meaning it's the easiest to audit, easiest for another person to come up with the same value. You'll also hear that referred to as mark to market. Level 2 fair values you use if you don't have level 1. Okay, that's where you would go next. Quoted market prices for similar assets, so it's still observable but less desirable, right? It's not the exact same asset, it's something similar that I can get an observed price. So, yeah, there's my mark to kind of market. If you don't have level 1 or level 2, you have to use level 3. That's where the management is basically coming up with its own idea of what fair value is based on cash flow models and get some valuation expertise in there to come up with the values. This is often referred to as mark to model. This would be the least verifiable. That'd be the hardest to audit, right? More expensive to audit, those level 3 fair values. Just real quick, in class we looked at the Coca-Cola 10Q and saw they used the very similar language. And I think I pointed out that you could pull up any 10Q or 10K and you're going to find this same language. It basically comes right out of the codification. So now with that in mind, we know where fair values come from. We know which level is the most verifiable, meaning it's the easiest to audit, which one you have to use the highest on the hierarchy, but it's the lowest number, level 1. You have to use if you can get it.